Hello, everyone. Welcome to All In on Real Estate. I'm your host, Aaron Goins. I started this meetup because when I was in the military, no one in my circles talked about real estate. A lot of times we talked about debt and other different finances, nothing about real estate. And I wanted to start a meetup where people can learn about real estate and start building generational wealth for them and their family. So I'm really excited for our guest speaker today, Mr. Tate Siemer. How you doing, Tate?
I'm fantastic, Aaron. Thank you for having me. It's an honor, and I'm hoping to drop some big bombs of knowledge and hopefully some good value for you guys.
Oh man, yeah, I'm always following Tate on his podcast. I've been on his podcast, and I'm always impressed with him and what he has done in his journey. So I really definitely want to dig into your story, man. So let's get started. Um, what is
Okay.
your origin story into real estate?
Yeah, I'm actually a photographer by trade. It's been a long time since I've done it professionally, but I originally from Cincinnati. I moved to Utah in 1999, last century, and I was a photographer for 10 years or so. But I got into real estate investing in 2006. I took a basic real estate investing class and learned how to flip single family houses and buy and hold and sort of thing. We learned a little bit about cap rates and some of the more commercial terms, but um, that got me going in single family flipping. And then I became a realtor and worked with investors. And then the crash happened, and I had never really hit a stride, to be honest, in that space. And so I was kind of glad to get out of the business at that point, and I went back to photography. Uh, and um, and then in 2011, my longtime, well, he was my boss. He was my first boss when I moved to Utah, and best friend. And Carl York is his name. And Carl came to me and said, "What would you think about flipping houses?" And I said, "Dude, I never want to do real estate again." Next thing I knew, we were flipping a house, and and started flipping houses as fast and hard as we could, using our own money and our own time and resources to GC the projects. And that, as you all probably know, is not very scalable. It's a tough gig. And so I guess about 6 years ago now, maybe 5 6 years ago, we decided to kind of expand our horizons and thought that development would be the next big uh, course for us. And we got into some land entitlement projects. We bought some lots and had them entitled for high density projects and townhomes mainly in downtown Salt Lake City. And uh, that went pretty well. We did some good deals, and then we thought we'd get really brave, and we did some ground up projects and built some townhomes, and quite frankly got our butts kicked on those. And I won't go too much into that. It was kind of painful. It was very painful actually, and but we learned a lot. And one of the things that happened during that time was we had a 12 unit apartment community kind of fall in our lap, literally. And it was about half vacant, and the other half was not paying rent, and they were month to month. So we got them out, and we did a head to toe remodel, everything from TPO membrane roof to floors to windows to mechanicals, solid surface countertops, and we literally doubled the rents at this property. And at the time, we needed to sell it. I wish we hadn't, because it would be wonderful to have that now. But we did real well on it. We made, I think, about 300,000 on that project. By far our biggest deal to that point in time, and basically really set us into the multifamily space. It was very eye-opening to us to underwrite projects that had cash flow, and enough cash flow to pay the mortgage, pay the bills, uh, pay our investors, and pay us. And I started going hard and heavy after uh, larger scale multifamily, and got into a coaching mastermind with Corey Peterson, the big kahuna, if you guys have heard of him, out of Phoenix. He's kind of a nationally known author and speaker and podcast host. And really learned the business from him as far as how to do deals, and he gave us a lot of confidence to go after larger scale deals, and we started making offers and writing LOIs and started to get to know different markets and kind of hone in on a few markets, and then we had a 20 unit in Utah come along in the course of doing all the business that we did. So we bought that, and that was another kind of flip, if you will. It took a year, but it was a project that we bought and renovated, put about 30 grand a unit into that place, and 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 did well on that. And then in the meantime, we were really honing in on Columbus, Ohio, and Oklahoma City as our kind of our target markets for larger scale projects. And I can go into why and how we did that. But and in 20, so this was literally in August of 2020, we owned no properties. We were upside down in our townhomes and trying to sell them. And we bought the 20 unit. And then in 2021, we acquired 6 different communities, totaling 572 doors, I think. 3 in Columbus, 3 in Oklahoma City, about $38 million worth of property. So it was kind of like the analogy of planting a bamboo tree, where you plant the tree in the ground, you water it for 5 years, and you don't see a single thing happen, and then all of a sudden, boom, it shoots up, and you've got 30-40 foot bamboo, what do they call those, shoots, bamboo shoots, and coming out of the ground. And that's kind of what happened to us in 2021, which was just last year. So we've since bought another Class A community in Columbus, and we're under contract on a Class A, 108 unit Class A community in Columbus right now. That's about $27 million acquisition. So that'll get us to about $75 million in assets under management. And I have a little team. Carl is still my partner, and I love him, and we work beautifully together. He's kind of our tactician, kind of our workhorse, CFO, COO. He handles a lot of the behind the scenes stuff that I don't want to handle. Quite frankly, I'm not good at it, and he is. And it allows me to kind of steer our company from the captain's quarters, if you will, and stay kind of big picture visionary. Basically president, CEO of the company. And then we had, in 2019, I went to Dealmaker Live with Michael Blanc, and that's a national conference I highly recommend going to. He does it every year. And I met a woman named Chelsea Garber, and Chelsea has become, long story short, she's become our third partner, and she's an awesome addition to the team. She heads up our acquisitions, and also very heavy in asset management. So, wow, that's really loud behind me. I apologize. I don't know if you can hear that or not, but so we are transitioning from Class C. The 6 properties we bought last year were all Class C value add, and they're tough. They're a tough row to hoe as far as turning the ship around from a distressed Class C property with distressed tenant base to a successful, stabilized project is tough. So, and we're not afraid of tough. We've done tough before, but we found a lot of great opportunity in the Class A space, especially in Columbus. And so we're in highest and best right now on another property that's it's going to sell for about $21 million. And we're up against one other group. I should have heard today whether we got it or not, but waiting patiently on that. So that would get us to just under $100 million, which was our goal for the year, was to get to $100 million in assets under management. So that's kind of our story. I'm sure I left out a few key details, but that's in a nutshell. That's kind of how we got to where we are. I love what I do. I'll get up in the middle of the night and work on stuff and spreadsheets and emails, and I truly love the business. I love the space, and I have a podcast. I love doing that. I love doing stuff like this, and helping other people. I'm actually starting a coaching program at the end of the summer, and right around September 1st, I'm going to be taking on about 6 clients, and the sole focus of that program is going to be getting people to their first deal if they haven't done a deal yet, or getting them to their next level if they have done a deal. So I love giving back and helping other people along the way. I had some amazing help and mentorship along the way, and so that's kind of my gig is going as big as we can, as fast as we can. We're not stopping right now with the shifting market and the rising interest rates and everything. We're still players. We're still underwriting deals all the time, and looking for good properties that cash flow, that we can get long-term fixed debt on, that we plan on holding for at least 5 years. So that's kind of what we're doing, man.
Wow. Wow. That's awesome, man. I definitely want to ask you about the markets, but let me ask you this question first. What did you learn? What was some of your biggest learning moments at the start of your real estate career?
Well, probably the biggest one was that we were not cut out to be builders or developers, for that matter, and we didn't have the skill set or the experience to do that asset class well, and we learned that. I mean, I guess the biggest lesson is kind of the magic of multifamily. Nika might disagree with me on that, but we love the the space because it's not largely not a speculative space, unlike single family projects and development projects, where you're counting on somebody coming along and buying an asset that you're working on for a certain price, and projecting profits that way. With, as you guys know, with commercial valuations based primarily on income and cap rates, obviously. So it's a space that, and when you're buying for cash flow, it's a space that is fairly predictable, and you can project profits and cash flow and exit profit and that sort of thing fairly well. But so I guess that was the biggest one. Another big area that I could talk about, all night, is mindset, and how we, and particularly I, developed the mindset to go after these multi-million-dollar assets, which, when we were flipping single family, like if somebody had told me that we could do apartments, I would have looked at them sideways, like that's for big people, like big money, and we're swimming in this pool that we can handle in the single family space. But we never really scaled up with single family. We thought that the smart thing to do was to use as much of our own money as we could and as much of our own time as we could on the job site. And it's just not a smart way to do this business, the single family space. So we would do maybe, 6 houses a year, and we did big, $1 million houses, but it still was something that we knew that we would never, or at least we thought we would never, really level up in that space. So we learned, I guess, the shortcomings of doing single family real estate, and we learned all that the hard way, especially that lesson. Trying to think if there's any. I mean, there were a zillion lessons along the way, for sure. But Um, yes, particularly in multifamily, I think we've learned how difficult it can be to take on a distressed Class C asset with a very distressed tenant base, um, and we've learned the benefits of um, investing in nicer, um, higher asset class type properties that have a better tenant base than where we've been with our Class C projects. So our Class C stuff is going well, but it's been up until maybe 6 months ago. We had a couple, and especially our Oklahoma City portfolio, that were very, very challenging. And we actually, most of that was because of our property manager, who we ended up firing. Um, that's another big lesson is, we've learned how to vet property managers and how to do due diligence on a property manager and how crucial that is. That's just such a crucial piece of business plan is uh, is getting the right property manager and working for you, because that's really where the rubber meets the road. It's where the business plan gets implemented, and if you don't have good quality property management in place, it's very difficult. So we've learned a lot about asset management as well, kind of related to the property management piece. We've learned how to asset manage well. We didn't really know that when we acquired our properties. And we're always learning. Like, as you guys can tell, we're not, we're pretty green, even though we've grown fast. We're we're still learning and growing along the way, and we learn stuff every day. So,
That's
does that
cool.
answer your question, Aaron?
Yes, sir. Yes, sir. It does. It does.
Yeah.
Um, so, how is it for you? And I know I love your passion for what you do, but take us behind the scenes. Like for you as a CEO, um, how has that been for you as far as the growth over the course of time for you in acquiring more property? So how is that growth for you?
Well, I mean, I'm kind of a deal junkie. I love doing deals. I love finding deals and underwriting deals and doing what it takes to get deals. I love the broker relations game. We get all of our deals through brokers. We don't do anything direct to seller at all. We tried that for about a year, and we had a person fully dedicated to direct to sales or direct to seller activities, and it wasn't fruitful for us, and it is for some people. But what we found is that the 100+ unit properties are 99% of the time sold through brokers. These guys, the owners are typically business people who are savvy, and they know that exposing their property to the market in a open situation is going to get the highest amount of dollars for their property. So we're all in 100% on broker relations. I really, as CEO, I really kind of head up that aspect of things along with Chelsea. And I guess what I've found is that um, a lot of the value that I bring is the podcast, hosting the podcast, being the face of the company. Um, I'm very active in our operations, asset management, particularly in acquisitions, and I guess I found, Aaron, that when you're starting up and growing, you kind of have to be jack of all trades in my position, or at least jack of a lot of trades, and you have to be a person that's willing to be responsible for uh, all aspects of the business, and the buck stops with me on everything, and I own that, and so I guess being 100% responsible bring in my A game every day. Back to mindset for a second. Like I show up every day like this, just ready to rock and ready to make connections. And this is very relational business. It's not transactional like single family is. It's we play the long game with our relationships, whether they're brokers or um, you know lenders, equity sources, investors, etc. Like we're developing relationships that we want to last a long time, and we want to do deals with the same people over and over again. So um, that's really our focus. There was something else I was just thinking of that I wanted to share with you guys, but I'm sure it'll come back. But um, so uh, yeah, I guess overall it's being 100% responsible and being the leader that our company deserves, and and really developing high quality relationships um, that are win-wins for everybody.
I love that. I love that, man. I love that. I love that. Just a couple more questions. Uh, what you know, what would you have done different at the start of? And I know you want to get in flex, but what would you have done different when you first got into real estate? I think you did a good job of like studying and reading and stuff like that. But what else you would have done different in your when you start off with real estate?
Yeah, in 2006 there weren't really podcasts. There weren't meetup groups. There weren't RIA meetings. And by the way, our local RIA, we have two local RIAs in Salt Lake City. I'm on the board of the Utah Real Estate Investor Association, and then the Salt Lake Real Estate Investor Association has been huge for me as well. And really, I actually owe it to my buddy Adam Adams, AAA. You may have heard of him. He came to the Salt Lake RIA and did a presentation on how to get into multifamily investing, and he was the first one that kind of looked me in the eye and said, "You can do this," and it was the first time that I ever believed I could do it. If I could do it differently, I would have just gone straight into multifamily and gone big out of the gate. Uh, the single family space, it's a grind, and it's really hard to level up. There's very little that is translatable between the single family space and the multifamily space, in my opinion. Um, and and it's a game that just requires its own skill set, its own set of specialized knowledge, its own relationships. I would not have become a realtor. There's nothing about being a realtor that's translatable, in my opinion, to multifam. Although you could argue maybe negotiations and contract negotiations, that sort of thing, is somewhat relatable. Dealing with lenders is somewhat relatable, but and so I encourage people, whether I'm in consulting with them and kind of coaching them, to really strongly consider that there's kind of a myth that you got to start small and work your way up. And if you're going to start small, start with small commercial multifamily, like get a 12 unit, a 20 unit, like we did, and start there. But you can start with an 80 unit or a 100 unit as well. Like there's things you need to put in place to do that. But I'm a firm believer that that's possible, and that there's a lot of huge benefits to doing that. So um, yeah, I mean, I guess I would have just avoided the single family space altogether if I could go back and do it again. I don't have any regrets in life in general. I'm not that kind of person. I believe that, the cliche, everything happens for a reason. I believe that. And I believe that everything happens in its own time. And so for me, everything's perfect the way it is and the way it was. But when I coach people and teach from my experience, that's kind of what I share with them is like, start big. There's no reason not to. And the only thing that keeps us from starting big is our mindset. It's our core beliefs and our limiting beliefs that shape what we do. So when I coach people, we start with mindset and limiting beliefs, and we blow those up, and then we go to work. Um, so yeah, really, that's really, I guess, what I would do differently. Yeah.
Love it. I love it, man. I think that's really, really cool right there. Um, so let's talk about markets. You say you were talking about markets. So why pick the market that you guys have picked?
Yeah, I mean, in general, as you guys know, markets, cities, urban markets, can be divided into two different categories. They're either going to be cash flow markets or they're going to be appreciation markets. And typically it's one or the other. So you take your Austin's a great example, Nika, and places like Dallas and Tampa and the Carolinas, and there's many others that are heavy appreciation markets. Salt Lake City is a great example of an appreciation market where you can do deals in those markets, but you can't cash flow in those markets because the pricing is so high. So, in other words, you're going to pay a price for a particular asset. You're going to go in and force appreciation. You're going to do a value add, typically raising rents and putting better management in place and renovating perhaps, and then raising the value of the project by raising rents and getting your NOI higher. And of course, that can be tackling expenses as well. And then the other category is a cash flow market, and I would say like a Cincinnati, where I'm from, or an Indianapolis, or there's so many of them in the Midwest, especially. Your Louisvilles, your Pittsburghs, your um, Lexingtons. Those are all markets that you can buy properties that will cash flow really well because the cap rates are still very high, and you can buy stuff. You can buy stuff in Cleveland, Ohio, for 40,000 a door. That's going to rent for $800-900 a unit, and that's going to cash flow really nicely. The problem is Cleveland, Ohio, is actually losing population. It's not losing huge numbers of people, but it's the opposite of a growth market, and so you can't really underwrite much in the way of organic appreciation based on the market. What we went out to look for is markets that capture both of those elements, cash flow and appreciation. And to me, those are kind of few and far between. And we've, obviously we just came out of a huge growth cycle where just about every market grew, but you, you look at, especially at population growth or population loss, and that's going to tell you whether it's a growth market or not. Nashville is a great example of a growth market right now. Tennessee's blowing up, um, and uh, Columbus, Ohio, and Oklahoma City are great examples of markets where you can buy properties that beat the 1% rule nicely, and are still growing nicely. Columbus is probably the best example out of the two. Population is growing there, unlike all the major markets around it, and and it's still very affordable. So our model, and our investors expect to get cash flow. They expect a preferred return, and so that's what we buy for. That's how we underwrite. But we also buy in markets that have some tailwind. In other words, markets that have population growth and have a high level of demand on multifamily. Typically, they're very good employment bases. Columbus has a very diverse employment market. There's all kinds of, you've got the state government, it's the state capital. It's got the third largest university in the country, in Ohio State University. It's got a lot of tech. It's got a lot of medical. There's some large hospitals there. It's the headquarters of a lot of retail and a lot of restaurants because it's very central to the country. A lot of logistics, and so with all of those different sources of employment, um, it's solid, right? You're not going to take it, unlike say like a what's the city in Texas I'm thinking of? A lot of those cities in Texas are based primarily on energy and oil, and if oil takes a hit, the whole market takes a hit. So with diversification and employment, that's key. You've got a lot of people moving to Columbus because the cost of living is low there, and there's not much in the way of traffic. It's kind of an easy place to live, and people love it. People love living there. The restaurant scene's great. The sports scene is great, and it's kind of got a hype right now. And so that's how we picked the markets that we did. I got to give my buddy Neil Bawa some credit on this. If you're not familiar with Neil, look him up. He's fascinating. He's a great guy, and he's known as the mad scientist of multifamily because he's data driven, he's analytics driven, and he's an expert in markets and analyzing markets and breaking them down. And I've had him on my podcast twice, and the last episode we did was terrific in terms of breaking down how to analyze a market. And he just really goes into like individual markets, and he's not afraid to make projections and predictions, which is one of the things I love about him. Is he's brave. Like, he's willing to say, this is going to happen in this market. And Columbus is one of his favorites. He uses it as an example a lot when he's teaching people how to analyze markets and break them down. So he really put us on the radar, put Columbus on the radar for us. I mentioned earlier I'm from Cincinnati, and Cincinnati's 2 hours south of Columbus, so I still have family there, friends, connections, and so we felt comfortable going in there to start because I had some familiarity with it, so that didn't hurt as well. But we primarily chose our two markets based on them being kind of hybrids with cash flow and appreciation. Oklahoma City was a market that Chelsea brought to us. She had spent a couple years, better part of a couple years, really getting to know that market and setting up relationships there. And so when she came on board with us, we already had a jump start on Oklahoma City. The affordability of Oklahoma City is remarkable. You can still buy stuff for 50, 60, 70,000 a door, and improve the units, improve the properties, and raise rents and get a nice return from those. So we're very active in both of those markets, and we're not active anywhere else. We've got really good deal flow from those two markets, and we have great property managers in both markets. We have a lot of expertise now in those two markets, and just tremendous broker relationships that get us good deals. A lot of times they're off-market deals or kind of semi-off-market deals. So that's how we pick those two markets. And again, when I'm coaching people and they're starting from scratch, I encourage them to pick one, maybe two markets as their target market. And we talk a lot about this cash flow versus appreciation game. And I really encourage people to become experts in a market, to go to the market like that. There's nothing that takes the place of putting your boots on the ground and going and nurturing those relationships. And again, it's so relational, right? If you're working the broker relations scene, which that's my recommendation at how people go about this. If you're, you know, you, these are people that you want to have on speed dial, and you want them to have you on speed dial. So, go into the market for 4 or 5 or 6 days, and getting to know the different neighborhoods and the different submarkets and the nuances of those markets is really, really key.
Cool, man. Cool. So, any last words? What would you tell somebody who is new into real estate and want to get into multifamily? What would you tell them the first things they would do?
Yeah, I mean, this is going to sound kind of weird, but I would say if you haven't done like your personal development work in life, uh, like do that do that stuff first, at least do it in at the same time, simultaneously with your real estate work. And so what I mean by that is if you've got um, if you got stuff running in your life that is negative, that could be like childhood stuff, or even adult type stuff. Um, do the work that it takes to heal that stuff. Um, and whether that's therapy, personal development work, um, taking up a practice like yoga, doing anything that will bust you through the constraints that you're dealing with. It's really, really hard to swim. You're kind of swimming upstream when you have some hangups that are holding you back. It's really hard to be very successful. And the whole idea of whether you believe you can or believe you can't, you're right. That is so true, especially in this space. If you have a core belief that's running the show, that you can only you can only do so much, or you can't do apartments. No matter what you do and how you do it, you're not going to be successful, in my opinion. On the other hand, if you have a core belief that you can do it, and all you need to do is be shown the way, in my opinion, there's no stopping you. So lay that foundation of who you are, how you know yourself to be. Do that personal development work. Like, there's nothing that replaces that, in my opinion. Um, so, and then as far as the real estate side of things, uh, I start people off with kind of developing your brand, like developing your team. I encourage everybody to develop a credibility kit, which is nothing more than a 5-6 page brochure about your company, who you are, who your team is, who your partners are, what your portfolio looks like. And if you don't have a portfolio yet, use your partner's portfolio. And by partner, I mean somebody that's willing to be basically on your board of advisors. That's what we did with Corey Peterson when we started. Corey and his wife Shelly were on our credibility kit as advisors, as partners, and we used his portfolio in our credibility kit. And there's nothing dishonest about that. Corey was more than willing to do deals with us, and it benefits him, right? And it also benefits us. But develop that credibility kit and have them printed out on nice glossy paper, and give those to brokers when you meet with them. Give it to lenders, give it to your equity sources, give it to property managers, because they're game changers. Like, so few people do stuff like that. And think about this from a broker's standpoint. They get probably 10 calls a day from people that want to buy properties, that are looking for properties, and they get asked out to lunch and coffee left and right. And quite frankly, the last thing a lot of those brokers want to do is go to lunch or coffee with a newbie. But if you can get in front of them, which that's not difficult. You can typically get a face-to-face somehow, and you hand them this really nice, shiny credibility kit, or a company profile is another name for it. Um, their eyes light up, like they're like, oh wow, this is cool, and they start flipping through it, and they see your team, and they see your strategy and your buying criteria, and they get to know you a lot better with that in their hands. So that's, if you guys want to take away, go. If you don't have it yet, go develop a credibility kit. I'm happy to help in any way that I can with that. And by the way, I'm happy to help any way I can with any of this stuff. Uh, and I'm sure we'll get to contact info here shortly. But like, I'm a no strings attached giver. Like, I want to help. I love seeing people grow, and to me, the only thing I ever ask of people is just to share their success with me, or share their failures with me. And like, I have an open Calendly link that people can book 10-15 minute sessions with me, and we can just kind of brainstorm your business, and look at maybe what's holding you back, and look at solutions to that, and look at really like what your next steps are in your business. Um, I forget what the question was now. I got on a little tangent there with the credibility kit, but I know what it was. What to do to get started. Um, yeah, again, I think just starting with mindset is really, really key, because most people, when they think about large scale apartment communities, it feels daunting, it feels big, it feels like you need a lot of money, a lot of experience, and the truth is that whatever you're missing in your business, it's available in a partnership. You go find the right partners or partner, and that has what you need in the way of experience. To get a loan on a commercial loan on a property, you need to have net worth, liquidity, and experience, track record. Well, guess what? Go find a partner. Go get a deal first. I'm a deal first guy. I really believe in going and getting a deal, and then figuring out the rest as you need to. Go get a deal, and then go to the biggest, baddest apartment syndicator that you can find in that market, and offer them 5-10% of the deal just to help you out, just to be an advisor. That's what we did, and our sponsor has done 5 or 6 deals with us now, and has invested in most of those deals, and he's allowed us to get, pretty big loans. I guess the biggest property we've done up to this point is 10 million. We're about to close on 27 million with him. So, probably the smartest thing we ever did actually was to go offer him a piece of a deal for nothing other than advising us. And it developed that relationship beautifully. He actually ended up investing in that first deal as well, and sponsoring the loan as well. But at first, that wasn't part of the deal that we approached him with. We just wanted him. We just wanted him to be looking over our shoulder at what we were doing, and making sure that we weren't making any big mistakes, and that we were being strategic. And so I highly, highly recommend that. But again, like, if you need money, if you need a deal, if you need sponsorship, whatever it is you need, you can find it in a partner. And that's why these meetup groups that we're doing right now are so key. It's why your real estate investor association groups are key. National conferences, guys, go to these national conferences. They are massively impactful. That's where I met Chelsea, and she's now, a very trusted partner. She's an equal partner to me in our business. And deals get done at these conferences. Just the networking. I mean, throw all the speakers out the window, and I love the speakers, but just the networking opportunity at these national conferences is huge. And if you want to contact me via email, I'm happy to share with you the ones that I think are critical to go to. And so, yeah, I mean, to me, those have been one of the biggest needle movers in our business. Is spending $2,000-3,000 to go to a national conference. I'm also a member of a mastermind. It's not multifamily specific. It's real estate specific, but there's 200 something people in this mastermind, and Tim Brott puts it on. If you've maybe heard of him, it's a national mastermind. We meet 3 times a year in person in different cities. We also have a daily Zoom call, which is remarkable. We have an hour-long daily Zoom call that you can participate in or not. And you have access to his team. You have access to his vault of documents and resources. And again, I've met equity brokers at these conferences. I've met individual investors at these conferences, or at the mastermind rather. So yeah, I mean, all these relationship building activities in this bigger asset class space are invaluable in this business. So, guys, I could go on on this around for for 2 hours, all night. I you know I'm obviously pretty passionate about this business and about helping people and adding value. You you know hopefully so far that you've gotten a little bit out of this, and um, and this is just kind of off the cuff. I didn't really prepare anything for tonight in the way of anything structured or formal. I'm just really sharing with you guys from the heart and from my experience.
I love it. I love it. I love it. Love it, Tate. Thank you so much, man. So I'm gonna open up for questions. From the audience. I know Brandon has asked. Let's see. Should I avoid negative population growth?
Um, well, I would say yes, you should, based on how we do business and what our model is. However, uh, you know, large apartment communities get bought and sold in negative population growth markets all day, every day. So there's people that have structured their model and their strategy around um, negative population growth centers, and what they're going for is cash flow. They're going for long-term hold, cash flowing properties that may or may not grow in value based on the market raising all ships. Right now, you can force appreciation in those markets by improving the property and raising rents and raising your net operating income. So you can do deals in those markets, but I guess my question on that would be why. Like, if there are markets that are growing, that are still affordable, like a Columbus, Ohio, like an Oklahoma City, uh, you know, why would you expose yourself, I guess, to the risk of negative population growth, unless you see something on the horizon there? And one example of that this is again in Columbus, but Intel just announced a $20 billion microchip factory on the northeast side of Columbus. And that's a seismic economic infusion, and it's going to create 10,000 jobs. Like, you got something like that going on, uh, or if you see it becoming more of a tech center in particular, maybe you do it. You kind of look for signs of what's to come, and you can still buy really nice cash flowing properties. One interesting market to me, by the way, is Kansas City. I think it's kind of a hybrid as well. And Tulsa is another one, where they're kind of flat as far as population growth. Cincinnati's another one. They're not really growing, but you can buy nicely cash flowing stuff there and force appreciation. And the chances of them growing are probably better than not. So, again, look up Neil Bawa, Bawa. He has a source called Multifamily U. just like it sounds, with a letter U at the end. And he's got tons of webinars and resources on there for right around this subject, right? So yeah, yeah, that would be my advice on negative population growth. Would be kind of why, like, unless there's a compelling reason to do it.
Cool. I saw you. So Marcus wanted to see how can you connect with you, Tate.
Yeah. I'll give you a couple things. So investwithgreenlight.com is our website. My Calendly link is on that website, so you can set an appointment with me that we can get, down and dirty, one on one, and really, really kind of deep dive as much as we can. In a say 10 to 20-minute session, and then we can talk about other possibilities around that. So investwithgreenlight.com, or I'll just give you my email address, which is tate@glequitygroup.com. That's another fantastic way of reaching me. And then my cell phone number is 801-699-4532. I'll put a couple of those in the I'll put my email address and phone number in the chat. I mean, this is a nice intimate group here, and hopefully people are listening to this on a recording as well. Anybody listening is welcome to reach out to me, and I mean that. Like, I'm not selling anything. I'm not. I don't have an agenda. Other than to help. So here, let me just. While I'm thinking of it, I'll just put my email address in here. So tate@glequitygroup.com. And then here's my cell phone. Text is probably better than a phone call in general, but and then I'll just put the website in here too, because that gets you my Calendly link.
Cool.
So there you go. That's all three resources.
Any more questions for Tate?
Shaniqua, I saw your comment on that. Thank you very much. Thanks for your feedback. I'm glad that hopefully you got some out of that. Nika, you got to have some questions.
Yeah, Nika, you got to ask one question.
I don't have any questions, but I definitely agree with the mindset thing. And it's funny because, as I'm talking to passive investors, because that's what I do and help, I get on the phone a lot with new people. They're just beginning, they're going to the networking things, and they can't, they can't think that they could become passive investors and not even try to do the active investing. And I'm like, if just skip those 2 years, you don't have to go through, we're all trying to get to this end game of the passive anyway. Just let that go. You can get better returns than you putting your 60 hours or your sweat into flipping that house and maybe losing all your money, so it is funny how, you have to kind of, but when you're new, it's hard to tell them, I've been there. Think about this. Don't, level up. Don't be afraid.
Yeah.
I agree with you.
The LP, the limited partner position, is the best position in all of these deals. They get paid the most. They get paid first. They have owners. They have the security of ownership.
Yeah.
And there's no doubt that, like you said, all of us are trying to get to that point of, I will probably always be an active, well, not always, but I'm in this for the long haul as an active investor and GP, but I am going to be an LP as well. As soon as I can, as soon as I can pull some of my own funds back out of our deals. But that's the end game, really, is to become a limited partner. So I like that a lot.
It's funny. I kind of walk them through, and like this girlfriend of mine, she's trying to break in right now, and and I've shown her some passive things, and then she did her numbers on a rental, and she was like, but that's like 10%. And I'm like, yeah, you're making the same, like I can get you more passive investment and you don't have to do all that, you can go bake, you can go be with your son. And it's like dawning on her now that she's doing the numbers for things, it's but the same way, I can't get away from, I enjoy it so much. I have my active stuff too, but the balance, you should always diversify anyway.
I agree. Most of our deals are projected for LPs to double their money in about 5 years, anywhere from 3 to 7 years. They're projected to double their money, or just about double their money. We shoot for a 2x equity multiple on our deals, and I mean that's great. I show me something else that is real, that's not volatile, relatively speaking. When you look at the stock market, when you look at other real estate asset classes, you've eliminated a lot of volatility because you have cash flow, right? You've got rents, and it's a universal need is housing, right? So everybody needs a place to live, even in a recession. And guess what? In a recession, a lot of times, especially your Class B, Class C assets, the demand actually goes up. And when there's inflation, rents are going up as well. So, like you don't expose yourself, in my opinion, to nearly as much risk when you invest in real estate. If you can double your money in 3 to 7 years, that's, man, like, again, show me something else where that's possible. That's not risky. That's maybe crypto, right? But that's risky as heck.
Yeah.
So
no, I like real estate that you're collateralized too. You can't get that out of the stock market. You can go touch and feel. I mean, most of the time, if someone's, passively investing in a multifamily out of state, they're not necessarily going to fly there before they invest and go look at it, but they could. It is there. They can go touch it if they want to.
Yeah. Some of our investors do. They'll fly to Columbus or Oklahoma City and go drive the property and go tour the property, and that's great. I mean, that's awesome. So, yeah. Is it Kayan? Am I saying that name right? Kayan James or Kayan?
Yes, Kayan. Yes, you said it right.
Kayan.
Hello.
Man, you just missed such an awesome presentation.
I know.
I'm kidding. I'm kidding. It's good to have you.
I'm sure it is awesome. Thank you. I see that we're talking about value. Where's the page? I haven't been here in a while, so since my schedule is a little bit flexible tonight, I'm like, let me pop on. But the time then went by so fast. So I see that we're talking about value adding, multifamily development, in apartment buildings. I'll tell you, I am a new investor here. I'm in the Bronx. If you are familiar with Laddie, Mr. International, Lawrence Laddie, I am not too far from him. It just so happens that we are close to each other. I am pursuing the Bronx. From the heart of revitalization and development standpoint, and I'm also interested in Connecticut as well.
Interesting.
So that's my piece there. Very, very new.
I know very, very little about investing in those markets. They don't really fit our model because we model cash flow. So we model profitable properties that cash flow in place. Mm-hmm. And that appreciate. So, we've been very specific with how we've chosen markets. But listen, I mean, there's a lot of ways to skin a cat.
Yes, there is. Connecticut, I would say a lot of folks look there for cash flow, less, depending on what part, less appreciation. But for New York, we know that New York is, as they say, a beast. And what folks tend to look for here is look for more so the appreciation, and then eventually the cash flow will follow. But that 1% rule, that 1% rule is gonna take like 10 years.
So, I live in Salt Lake City, and Salt Lake City is an
In
appreciation
Utah? In
market like
Utah?
New York. I did, yeah, Utah, yep. And we don't invest locally because it's same. I mean, it's different, obviously, very different than New York City. But as far as you can play the appreciation game there, and you can force appreciation, and you can buy something for X,
Yeah.
raise the value, and sell it
Yeah.
for Y, and make good money. Our investors expect an ongoing preferred return in what we do. So,
Mm-hmm.
so we
Syndication.
what's that?
Syndication? Is that what
We do
what
syndicate.
you
We do
go for?
syndicate.
Oh,
Yep.
okay.
Yep.
Okay.
We do syndicate. So,
I'm learning
so
I'm learning about syndications because I have an interest to do my first one or in the first quarter, hopefully of next year. If not, this last quarter
nice,
here, we shall see. But I have a
nice.
huge interest in that. Hmm.
Well, listen, I put my contact info in the chat. Um, grab that contact info and let's get on a
I think
Zoom
you have
call
to,
sometime.
you got to repost. You got to repost it because I just came in, so I don't see it here.
Okay, yeah, I'll do that. I'm gonna put our website up there, which has
I
my
got it. I
Calendly
got it.
link
I
on
got
it.
it. I got it.
Okay, cool. Thanks, bud.
Hi, Aaron. Thank you.
I'm happy, KN. I'm happy to help. To get on one-on-one with you, and we can talk. Getting your first deal is a very, very big deal. It's
know.
the hardest. It's the hardest deal you'll ever do, and it's also the most important deal you'll ever do because things start to get easier after that first deal. You're on the map. Brokers all of a sudden know who you are. You've got a little bit of a track record now, and things get easier. So it's
Okay.
really important that you get that deal done, and being as challenging as it is because of the lack. You don't have the experience and the relationships necessarily yet, or they're not as well developed yet. It's important that you get it done and that you have
Right.
some mentorship in the meantime. So I'm happy to help
Yeah.
any way I can.
Okay, you're setting me at Tate. That's how I say your name, right?
Yep.
Tate. Yeah, you're setting me up for
Tate.
the major leagues. Tate. Yes. Listen, I was planning to hop on somebody else's deal as an LP, but now you're setting me up for the major leagues.
Well, listen, we just
So I
Nika and I
say it
were
again.
just talking about Nika and I were just talking about how being an LP is a great place to be. There's nothing wrong with being an LP, and there's a lot right with being an LP. Being a GP, being the operator, the sponsor of the deal is there's a lot to it. There's a lot of moving parts,
Yeah.
and it's not easy. It's not easy. I'll just put it that way. It's hard work. I work probably 60 hours a week, 50, 60 hours a week most weeks, and luckily I love it. There's really, aside from skiing and mountain biking and hanging out with my dog, there's nothing I'd rather be doing.
But that I think it's called the acquisition fee makes all the difference, right? Being able to benefit from that
I mean,
part.
that's the acquisition fee is very nice, and you do benefit from that. But as an LP, we were just talking. You can, in the right deal, you can double your money in 3 to 7 years, and that's significant. So, we were Nika and I were just talking about how being an LP is kind of everybody's ultimate destination in this space. I certainly want to be an LP as much as I can be, but I love doing what I do, so I'll continue doing that as well long term.
What's the name of that position? What's the name of the position you stated?
GP or general partner or
no, just now
operator.
you said you just gave the acronym for another one. PD something.
LP.
PD?
I'm not sure.
You said something.
Limited partner.
No, I thought you just said another term just now. Maybe I misunderstood. Where you said that's where
I might have said LP. LP is what I meant if I didn't say it. LP
no,
is
the position
really.
I should say is where we all want to be? Which position do we
LP.
all want to be in?
LP,
Okay.
limited partner, because
Why is
you're
that?
not doing any work, and you're
Oh,
secured by you're collateralized by real estate. You're getting paid first. You're getting paid the most. We have a 70-30 split on most of our deals. So 70% of our equity goes to our LPs. So you're making more than us. And
Yeah.
and guess what? Here's another aspect is if you get in with a good syndicator or a good GP that's willing
yeah,
to share with you what's going on in the deal and maybe include you in some
yeah,
meetings and email chains and
yeah.
stuff like that. That's one of the
That's what
best
I'm
ways
hoping
to learn
for.
how to be a GP.
Yeah,
So
that's what I'm hoping for.
Be the
yeah,
bank, as they say. You want to be the
yeah.
bank. And my friend that she does notes, so she always says be the bank, but she's like, I'm at the top of the food chain.
Yeah, we want to control and own. Okay,
Yeah.
control and own.
She
Yeah,
loves doing the be the bank.
yeah.
So don't write off being an LP first is what I would say.
Okay.
Yeah.
There's a lot of ways to go about this. I didn't do it that way. I went in straight into being a GP, but I see people do that a lot, and I've got investors that I'm kind of an open book. So if an LP in one of our deals wants to learn about the deal as we go, like I'll share with them anything they want to know about it.
Yeah,
So it's a good way to
yeah,
learn the business.
yeah. I am looking forward to learning that role. There's so many options. There's so many options in real estate, and I think for me, I'm just recognizing like these first 2 years, um, meaning this year and next year, will probably be a lot of time figuring out which avenues in which I want to tackle this thing, because I've started out thinking, okay, I'm gonna do the buy and hold with the triplexes and the quadplexes and the duplexes, but then it's just so much work to get those smaller units, and it's like one just fell through. 2 weeks now, we had to terminate a week before closing on a triplex in Connecticut, and I'm like, man, listen, we just spent 2 months doing this. The next time we do this
Right.
again, let's go for something commercial. Does it make sense?
Yeah.
Um, there's just so
There's
much to
just as
figure
much
out.
work.
So
There's just as much work involved in doing a 30 unit or a 300 unit as there is in doing a 3 unit. I promise you that's
yeah,
the case.
And it's
And in
true.
fact,
yeah,
Yeah.
sometimes the smaller, sometimes those smaller units are more work, and they're less
mm-hmm,
predictable because they're not commercial assets. So, um,
yeah,
yeah,
yeah.
yeah,
And what?
that would be. I would encourage. And here's the other thing I would encourage you to do is shorten that timeline. You just said something about,
Yeah,
the next year or 2 years is going to be about finding your lane. Compress that into
yeah.
six
Shorten it.
months.
Yeah.
Yeah,
Okay. That means
I mean,
from
and
January.
take massive action. It's like at
Yeah,
some point you just got to go for it. It's never going to feel comfortable. You're never going to feel 100% ready.
yeah,
But at some
yeah,
point you just got to go for it.
Oh,
yeah,
I'd like to add one thing about that no coaches ever end up saying in real estate. They just start taking you down these like learn multifamily. They start with the asset classes. And like you said, with the mindset, you should really take stock. What is your skill set?
Yep.
What do you bring
So
to the
important.
table? What did you do in your old life? Are you a
mhm.
Yep.
numbers person? Are you a talker?
I'm a numbers and a people person.
Yeah, good,
Yeah,
good.
yeah,
Or do you know design, construction?
Yep.
Like,
yeah,
Yep.
what is your skill
Underwriting.
set? And find
yeah,
that partner that doesn't
yeah,
have that, or say, or go to them. This is what I have,
yeah,
you know. Yeah.
I
As
call
well
that
as
I call
finding
that
which asset class. Yeah.
I call that finding your superpower
Yeah.
and build your team and build your partnerships and build your business around your superpowers
Right.
and and just fill in the gaps with other people. There's a great book called Who Not How.
yeah.
Um,
Lee
trying to
told
remember
us
the author's
about
name.
it.
Who
Yeah,
not
Who
how.
Not
That's
How. Like it's all about finding the right people to fill in those gaps that you're not good at, right? And we're all good at certain things, and we're all not good at certain things. So there's aspects of this business that I'm just not good at, and I don't want to do because I'm not good at it. But if you really focus on your superpowers, you're gonna like what you do because you're gonna be more successful at it.
Mm-hmm.
So, and that's so important. Like, I mean, ultimately, at the end of the day, I love Gary Vaynerchuk, Gary V, and he's he's a public speaker and an author, and he talks about how at the end of the day, this is all about just being happy. Like he knows people that make $60,000 a year, and they play on 7 softball teams, and they take 1 vacation a year, and they're happy as can be, and there's nothing wrong with that. Maybe not the path that we're choosing, right? But you gotta be happy. You gotta enjoy this, and otherwise, it's not sustainable.
I wholesomely agree, because I was getting frustrated a couple weeks ago, and I said to myself, "Wait, this is not the enjoying the journey, really zooming in on that journey, the part of the process." Because sometimes we get so focused on the destination, but most of the time is spent on the road there and finding the beauty in that. So right. I'm better now.
Nice.
To the process.
Nice.
To the process.
Perfect.
As I said, I am very
awesome.
new. I'm in my first.
I love it, and you're in a cool spot, and oh man,
I have to run, but it was nice to meet everyone. Thank you, Tate.
It's nice.
I enjoyed it. I enjoyed
Thank you very much, and thanks for your contributions.
You have a very positive, good attitude. That's the most important.
Nika is a future guest speaker too, so
one of these days. Yeah, I'm about to go on vacation. You gotta catch me. I'll do the Thanksgiving one.
Oh my gosh.
Where are you going, Nika? I'm traveling too. Where are you heading?
Well, I'm going to New York City. It's not the relaxing beach vacation, but
business vacation, yes.
Well, it's just no, I'm going for pleasure, but I lived in New York City for 8 years, and I haven't been back in a really long time, and just want to visit. And we had family member move to upstate New York, so we can kind of go there too. I'm only going to go for 2 or 3 days in the city, but then I'll be upstate, so which is a little more relaxing, and there'll be more horseback riding, go-karting, stuff like that.
Yeah.
But I got to get some foods and some sights into the city. Take my son. He's 11 now, so he hasn't seen it. He was born there, and he doesn't really remember New York City. So for him to go get to see all the buildings and the sights, and he's excited.
That's great.
It's for his birthday.
Oh, happy birthday! Beautiful.
Yeah.
Awesome.
So
thanks for all your contribution, Nika. Good talking to you, and good getting to know you a little bit.
Yeah, good to know you too. And I saved the chat, and we'll talk one day.
See you soon, Nika.
Let's stay in touch.
All right, bye.
Tell your son to say hi.
I will. Yeah.
Cool guy. I had an opportunity to meet Nika and her son and Peggy last week, so had a great time with them.
And Shaniqua. Or we did. You already know her, but yeah.
Yeah. All
right. Bye.
Bye, Nika.
Shanika, you got anything to add? You have anything you want to ask before we end the meetup?
No, I learned a lot from what I just came in, and I'm gonna reach out to Tate to see, to pick his brain about stuff.
Awesome.
You guys got, I'm more interested in multifamily, but all you commercial people got my head spinning. Dang, maybe I need to transition to commercial for my first deal. So I'm just processing it all.
I'm in commercial multifamily.
Yes, but I just wanted the small unit one. The 3 family that you said is better to do.
Are you going to be house hacking, Shaniqua?
Potentially, I'm not sure yet.
Okay, because I was going to say, if you're going to be house hacking, then, getting a smaller for your first is, a great start. That's what I'm doing right now. But as I just mentioned, because of how much work it is running around doing all these 2-hour, 2.5, 3-hour drives to these different, outside outskirts of towns to research and open house and et cetera, these smaller multis, might as well, if you can you know, come together with some folks, or you have the capital yourself to look at potentially, you know, a 5 unit, a 6 unit, 8 unit, 10 unit above, you know. Yeah, it may work out better numbers wise if you're not going to be living in it as a start. If you
Yeah, I
have
mean, the one thing I will say when you guys talk about superpowers, I'm a social worker by trade, so I'm super resourceful and I like researching everything. So that might be the thing that I may be able to bring to the table of whoever I end up working with.
yeah.
She's a good one. She's a good one. She's a good one.
Nice.
Awesome.
Well, look, I'm going to just stop the recording. We can still continue to talk, but I just want to say thank you to Tate once again. It's been a pleasure to have you on here, man. I think a lot of people on here got a lot of value, and when it's posted tonight, they're going to have more value on the YouTube page. So thank you so much, man, for your sharing your story and your wisdom as well.
Dude, it's my pleasure. Anything I can do for you and your community makes me happy. So, it's my pleasure. It's an honor. Thank you.
Thanks, Tate.
Yeah, thanks, Tate. Though I missed it.
Thanks,
I'm gonna see it on
Marcus.
the YouTube.
Yes, thank you, Tate.
Thank you so much, guys. Everybody, I appreciate all of you.
All right, guys. So thank you guys very much for coming. We will see you next week. God bless you. Take care.
All right. Take care, everybody.